Okay, so let's get right into it. Why does price sometimes move before the big news even drops? Most traders think news is what drives the market, but that's really only half the story. And honestly, misunderstanding this one thing is probably why so many of them end up losing money.
All right, here's what we're going to cover in this explainer. First, we'll tackle that pre-news mystery. Then, we'll look at the big players, retail versus smart money. From there, we'll get into something called the Great Liquidity Hunt. We'll even learn how to read their playbook, and hopefully, by the end, you'll have a totally new way of looking at the market.
All right, let's kick things off with a situation that I'm pretty sure many of you have been in. It's one of those moments that's just super confusing if you don't know what's happening behind the curtain.
I mean, you've definitely seen this, right? A huge economic announcement is just minutes away, but the price, it's already going wild. You're scrambling, checking the news feeds, and nothing. It's radio silence. So what on earth is actually driving that move?
And of course, what's the first thing everyone thinks? A leak. Someone on the inside must have the info early. But, that's a huge misunderstanding of how these markets really, truly operate.
The real reason, well, it has nothing to do with secret information. It's actually all about a hunt for the one thing that fuels the entire market: liquidity.
Okay, so to really get what this hunt is all about, we first have to understand the two main groups of players in the market. Because believe me, their goals could not be more different.
So on one side, you've got us, the retail traders. We tend to react to the news as it happens. But on the other side, you have the smart money. We're talking about the huge institutions, the banks. And here's the thing, they don't react, they anticipate. And to pull off their massive trades, they need something that retail traders unknowingly provide. Think about it. For a giant bank to place a $1 billion buy order, they need $1 billion worth of sell orders on the other side. That big pool of available orders, that's liquidity. It's the fuel. Without it, their huge order would just shove the price way up against them before they could even get filled. It'd be a total disaster for their position. So the big question is, how did these institutions get all that liquidity they need? Well, here's the secret. They don't just sit around and wait for it to appear. No way. They actually go out and engineer the market to create it for them.
And how do they do that? Well, retail traders like us, we can be pretty predictable, right? We tend to place our stop-loss orders or our breakout orders in the exact same, really obvious places. Think about it. Above recent highs, below recent lows. These spots become these dense clusters of orders, creating huge pools of liquidity. And for an institution, that's not just data, it's a treasure map. So, because they know exactly where those orders are stacked up, institutions will intentionally push the price right into those areas. This move has a name. It's called inducement. It's a deliberate move designed for one reason and one reason only: to trigger all those retail orders, which creates the flood of liquidity they need to get into their own massive positions.
And this whole thing plays out like a three-step formula. It's pretty incredible. Step 1, they find those liquidity pools on their treasure map. Step 2, they push the price hard, that's the inducement, right into that zone to trip all the wires and trigger everyone's orders. And then step 3, this is the magic. As all those retail orders hit the market, the institutions are on the other side, just quietly absorbing all of it. They're filling their own huge positions for the real move they wanted to make all along, which is usually in the complete opposite direction.
Now, I know this might sound like some secret, invisible game that they're playing, but it's really not. This hunt for liquidity actually leaves behind very clear footprints all over the price chart. And the best part is, anyone can learn how to spot them.
So, how do we see this happening? Simple. We look for their footprints. Let's break down two of the most common ones you'll see. Okay, the first footprint is called an order block. So what is it? It's basically the very last down candle right before a huge up move, or vice versa. That little candle, that's the spot. That's the zone where the institution soaked up all that liquidity and placed their big bets. And the second footprint? It's something called a fair value gap, or an FVG for short. This shows up when price moves so fast and so hard that it literally leaves a gap or an imbalance on the chart. The best way to think about this gap is like a magnet. Price often gets pulled back to fill that gap and rebalance itself before it takes off again.
So, what does this all mean for you? What's the big takeaway? Well, it's a completely new way to see the market. It's time to stop thinking that price is just reacting to news. Instead, start seeing it for what it is: a constant, relentless search for liquidity.
Seriously, this is the most important mental shift you can make. Price doesn't move because of the news. Price moves to where the liquidity is. That big move before the news, it's not about what the headline is going to say. It's about institutions setting up the chessboard. They're grabbing all the liquidity they need before the chaos of the news release so they can use that volatility to power their real trade.
I want you to really let this sink in. Price moves where liquidity is, not where headlines are. This one idea changes everything about how you read a chart. You'll stop asking, what's the news? And you'll start asking a much better question, where's the liquidity?
So, you can see the difference, right? The old news-driven model has you thinking there's a leak, and you're just reacting, always a step behind. But the new liquidity-driven model, that's where you start to see the game being played. You start anticipating. Your entire mindset shifts from being reactive to being proactive.
So here's a question for you. The next time you see price make a big move right before the news comes out, what are you going to think? Are you going to think leak or are you going to think liquidity hunt? Because once you understand this framework, you stop being a headline chaser and you start learning how to read the institutional playbook.
Hey, if this explanation helped you see things a little more clearly, maybe gave you that aha moment, then think about subscribing for more. We're all about digging into how price actually moves, not just chasing the noise in the headlines. Thanks for tuning in.